Welcome, everyone, and thank you for joining us. Today, we'll be exploring one of the most dramatic episodes in modern financial history, the rise and fall of long term capital management, or LTCM. This is not just a story about a hedge fund, it's a real world case study in financial engineering, risk modeling, system fragility, and human overconfidence. LTCM brought together some of the brightest minds in finance, traders, quants, and even Nobel Prize winners, and used sophisticated models to seek small but consistent profits. But in 1998, it all unraveled very quickly and very publicly, posing such a systemic risk that the Federal Reserve had to step in and coordinate a private sector rescue. Our goal today is to walk you through LTCM's formation, strategies, collapse, and the broader lessons it left behind for global finance. This presentation is brought to you by Team 9, Albena, Praveen, Alexi, and Tom. Let's get started. Let's start with the origins of LTCM. In 1991, John Meriwether left Salomon Brothers following a treasury bond scandal, not due to personal wrongdoing, but reputational fallout. He aimed to create a new kind of hedge fund, blending Wall Street trading skill with academic rigor. Meriwether assembled an elite team, including Solomon veterans and economists Robert Merton and Black-Scholes, both future Nobel laureates. LTCM launched in 1994 with about $1 billion in seed capital from institutional investors and ultra high net worth clients. The firm set up in Greenwich, Connecticut, fostering a focused, politics free environment described as Solomon without the politics. LTCM was designed to combine deep theory with market execution, something that initially worked brilliantly, but also planted the seeds of future risk. LTCM was intentionally lean, launching with just 41 employees. Operations and marketing were outsourced so that the team focused purely on trading and research. Its fee structure was premium, 2% management fee and 25% performance fee. But partners invested heavily alongside clients, which ensured strong alignment. Investor capital was locked in for 3 years with 1 year withdrawal notice. This provided a stable funding base, which was very critical for holding longer term positions. Early performance was exceptional. Returns exceeded over 40%, which quickly attracted more capital and helped LTCM scale rapidly. With strong performance, elite talent, and disciplined structure, LTCM looked bulletproof, at least for a while. Now, let's look at how LTCM actually made money, what strategies it used. LTCM specialized in relative value arbitrage. What that means is it bet on the convergence of prices between closely related securities, like two bonds with similar characteristics that were temporarily priced differently. These trades spanned asset classes, fixed income, equity, and derivatives. The key idea was to identify inefficiencies caused by things like liquidity issues, market segmentation, or accounting rules. One important tactic was selling volatility. LTSM sold long dated options when implied volatility was significantly higher than the actual market. This strategy worked well in stable markets, but carried risk during times of stress. They also stepped into markets where others couldn't. For example, LTCM took on positions that regulated entities like banks or insurance corporations were restricted from holding, creating opportunities to profit from structural constraints as well. In short, LTCM targeted small, seemingly low risk inefficiencies and used leverage to turn those into meaningful profits. Now, let's walk through a few real examples of the kinds of trades LTCM made. First, in US treasuries, they would buy older, less liquid bonds called off the run and sell newer, more liquid ones called on the run, betting small price gap would close over time. In Europe, they bet on convergence between two types of Italian government bonds, CCTs and BOTs, expecting yields to align as the Eurozone integration moved forward. They also traded on price gaps between Royal Dutch and Shell, which were two listings of the same company, even though they shared the same cash flows, they often traded at different prices in different markets. Another common trade, shorting US treasuries and going long interest rate swaps. They believed the spread between the two was too wide and would eventually narrow. Lastly, they sold long dated S&P options when the implied volatility was much higher than what the market had actually shown, profiting as that gap corrected. Each of these trades seemed low risk on its own, but when scaled up with leverage and put on all at once, they created much bigger exposure than expected.
LTCM's WAR model promised safety, calculating max losses in 99% of scenarios. They assumed strategies like Italian bonds and US volatility were uncorrelated. Aiding trades lowered risk mathematically, justifying massive leverage. They even returned $2.7 billion to investors in 1997, trusting the models. But two flaws lurked: tails risks beyond 99%, and risk created by their own success. The math ignored that markets adapt and turn against you. LTCM's models missed two bombs. First, tail risks, extreme events breaking historical patterns. Second, endogenous risk. Their success led rivals to copy trades. Uncorrelated strategies moved in lockstep via trader correlation. Diversification failed because the market became one crowded bet. Models built on past data could not predict this feedback loop. Russia's default was a detonator. Panic caused flight to quality, dumping risky assets for US bonds. Spreads LTCM bet would converge exploded. Their core assumption, the slinky effect, failed. All arbitrageurs were insolvent. Forced sales of identical position deepened losses. LTCM lost $1.9 billion in August, a statistically impossible event. The lesson is models can't predict liquidity crashes when everyone owns the same trade. LTCM scale killed it. Their trades were copied so widely that markets froze during liquidation. No buyers for massive positions. Worse, rivals like Goldman Sachs attacked their own trades, accelerating losses.
Thank you, Alexei. Well, in 1998, long-term capital management found itself at the center of a financial storm that would shake global markets to their core. The fund, once considered invincible, was about to face its most devastating challenge. The trouble began in May 98 when a series of global economic tremors started to ripple across the international market. The IMF bailout of Indonesia faltered, Japan suffered its first recession in 25 years, and Russia was forced to triple its interest rates to stop capital from fleeing the country. So, naturally, investors' panic drove everyone towards the safety of US government bonds. LTCM's fundamental strategy was based on a simple premise. Rational arbitrage would always prevail over market irrationality. But as markets began to crack, this assumption was brutally tested. The fund had aggressively betting against market volatility, and each percentage point rise was costing them $40 million. So by June, their losses had already reached 16% of their capital. Interestingly, the following month in July, the markets recovered a bit, and LTCM's management team shrugged it off as a one-off. Unfortunately, on August 17th, Russia defaulted on its debt payments, and things took a turn for the worst. This single event triggered a massive flight to quality, investors abandoning risky investments and piling into safe government securities. LTCM's portfolio began to unravel. What the fund hadn't anticipated was how their own success would become their greatest vulnerability. An entire ecosystem of traders had begun mimicking the LTCM strategies, creating an overcrowded trade with no room to exit. And when panics hit, there was simply no one left to buy their positions. Desperate to save the fund, Meriwether, one of the founders, reached out to potential investors. Warren Buffett refused. George Soros offered only a conditional lifeline. Wall Street began to smell blood, and traders started betting against LTCM's positions. The situation became so critical that the founders were forced to approach the Federal Reserve. Peter Fisher, one of the key Fed officials, realized the potential systemic risk. If LTCM collapsed, it could trigger a global financial meltdown. Its 17 biggest counterparties stood to lose around $3 billion. The only solution was an unprecedented rescue operation. The Fed orchestrated a consortium of 11 major banks, each contributing about $300 million to purchase LTCM's portfolio and prevent a total market collapse. At the end, LTCM's founders saw their personal fortunes reduced to almost nothing. The fund's spectacular failure became a cautionary tale about the dangers of over-leveraging and the unpredictability of global financial markets. The LTCM crisis exposed the fragility of even the most sophisticated financial models and demonstrated how, when panic takes hold, mathematical certainties can quickly become mathematical fictions. Thank you.
What crucial lessons can we draw from the LTCM episode? First, LTCM's failure starkly revealed the perils of excessive leverage within the broader financial system, not just hedge funds. Recklessness wasn't exclusive to LTCM. Its downfall coincided with frightening losses at major investment banks, showing that systemic vulnerability extended far beyond individual funds. Second, even LTCM's highly sophisticated risk modeling, like value at risk and stress tests, proved to be unavoidably brittle. These models, based on historical data, couldn't anticipate extreme, unprecedented events or how correlations between seemingly diverse positions could skyrocket during a panic. The crisis highlighted that true diversification limits were often misunderstood, as seemingly unrelated assets could collapse simultaneously if they shared a common liquidity risk premium. Third, the episode exposes regulatory blind spots. Despite the clear systemic risks posed by such highly leveraged institutions, initial regulatory responses were largely muted, relying on the flawed assumption that private creditors would sufficiently discipline risk-taking. However, it also taught us that market discipline can be brutally effective. Later events demonstrated that while some hedge funds might spark fires, others with strong liquidity management can act as firefighters, limiting broader systemic harm without taxpayer bailouts. Fabled QR and part-time gardener Gappy Paleolago was misquoted last week as saying, "The market is just a conversation between four hedge funds." Now, he didn't exactly say that, but he thought it was cute, and though reductive, it's instructive, so I'm going to keep saying it. In summary, LTCM underscored the need for humility in risk measurement, the true limits of diversification, and the complex challenge of managing systemic risk in a highly interconnected financial world. On behalf of Albina, Alexi, Praveen, and the whole Team 9 Reports news team, good night, and please leverage responsibly.